Good morning again. Howard Wayland here. We're going to talk today about buying an existing business. Now this is basically a starter promo to it. Really, buying a business has a lot more detail, but to give you kind of the information to understand the concepts of buying a business as a potential opportunity. Many pros and cons. Let's start with the pros. The business already has a set of existing customers who do business with it, hopefully on a continuing basis. That's an important process. In marketing, you'll find out that a customer is much more apt to return to the company it does business with than start doing business with a new one. So having a built-in group of customers that you're already doing business with makes it much more the potential for success because you're not having to struggle to get the customers to you. Also, everything is already set up to operate. You don't have to spend all your time creating procedures, calling for new vendors to deliver certain products or services for you. It's already there. Now you can add more, let some go, etc. But the key is that everything is set to operate and you don't have to spend your time there. You can concentrate on selling and understanding the needs of your business customer, and then providing them with the service and products that they need. Experienced workers. The people already working for the company already know how to do it. They can assist you in that transition, and they may not have written rules on how to do the items at their business, but there'll be at least every company has their own verbal rules on how they do it. I mean, most of them may have been taught one time on how to do the cash register, and that's why they've always done it. Doesn't necessarily mean it's written, but that's okay. An experienced worker can train. If you want to write them down and create some written procedures, which is important, I think you should. But the point is, you already have people that know what they're doing and you don't have to train somebody from scratch. Establish contracts with vendors. You don't have to spend all your time going and getting vendors. Additionally, companies that are already set up and doing operations, it's much easier to add vendors because you're already ongoing operations. New vendors have a little more difficulty sometimes in getting the products from some of these manufacturers, especially because they want to make sure that you're going to stay around and that you're going to provide the level of service to their customers that they would require. The cons, though, is that there could be hidden liabilities when you purchase it. Now we're going to show you a little bit on how to limit those liabilities, and there'll always be warranties, etc. But you know, if the guy goes off and now lives in Cancun, there's not going to be a whole lot you can do about suing him and getting him to pay up. So keep that in mind. And a lot of these liabilities could be governmental or things you can't even think of now. For instance, if they manufacture something, there could be a recall that you're demanded to recall that product that could cost you so much money you cannot continue to sustain the business. So you have to understand those types of things. You're also buying earnings primarily, as well as the products when you purchase it. So you're going to pay a premium if it's a good business to the actual assets that you're going to be purchasing. But for that, you're getting customers. So it's not completely negative, but it is a more expensive transaction for you. And therefore leads to the next one. It's a higher relative cost. Again, everything is set up. They've done that work, so you're not having to pay for it in actual money and time of your own. You're having to pay for it in cash or in a note that you do in the transaction. So keep that in mind. And there could be undisclosed issues, especially liabilities, taxes that you're unaware of. And quite frankly, the business owner that currently owns it may not even be aware of it. That happens too. But you really need to know why they're selling a business to try to minimize this. So let's look at the next step. There's really just two ways to purchase a business. A stock purchase. Now, if it's an LLC, it'd be a memberships agreement that's transferred to you. But a stock purchase means you're getting everything in the business through the transfer of its ownership rights, the stock. And that is a more risky type of operation. Now, some franchises, because the franchise agreements make sense to do it this way, as well as companies that have contractual relationships with a lot of people or that are hard to get. When I was with a mortgage banker, I had specialized negotiated contracts with over 500 banks and institutions. And so it would have been very difficult to do just an asset buy unless they were the same type of industry with the same type of contacts. It would be just difficult. And buying the assets is the second way, and that's the less riskier way, and the way your attorneys will more than likely ask you to try to do it. The reason for it is because you're only buying the assets and not the risk associated with the previous company. Now, by buying the assets, you have to understand you can still buy the trademarks and patents. It's not just the inventory, receivables. It can be assets, trademarks, customer list, the whole bit. So keep that in mind. Investigating and evaluating available businesses. Due diligence is the investigation of the business to make sure the information that you've been given is accurate and that there's nothing that has not been undisclosed, and that everything that's been disclosed is what you expect a reasonable person to have in evaluating that opportunity. Now, anytime you're doing due diligence, this is a must. And I don't care if you're an accountant or an attorney. You must get outside accountants, not just anybody, but transactional accountants who have done transactions of business sales on numerous occasions. And transactional attorneys, not your friend who's an attorney who does DUI. Get somebody who can do corporate transactions. And if the company you have has anything to do with securities, in other words, it might be a small over-the-counter bulletin board public company, or any type of public company, either here or on a foreign exchange, you must have a securities attorney do it too. You've got to have both types of attorneys if that occurs. And the other experienced owners. Now, what I'm saying by that is if you know of somebody that has been a consultant, that has bought and sold several businesses, heed their advice and talk to them about it. They probably will be more than giving you their wisdom, and most of them will give it to you from the way they got burned by the other company. So understand there's much knowledge in doing it wrong, but you don't want to gain that knowledge yourself. This is an important question. Find out why the business is for sale. Now, if a guy who's 50 years old is running a business, has done very well, all of a sudden he's getting out, that's going to put, my antennas are going up and back saying, why? He's really too young to retire. Is he sick? Has he had illnesses? Now, if he says his wife had cancer for 6 months, expected to live for another 6 months to a year, I really want to spend time with her, well, validate it, but if that's the case, that makes perfect sense. But is it old age or illness? Excellent reason, and those are the best ones to get from, because it might help you transition a little bit if they can on the old age. It may not can for the illness, but they're not going to be wanting to get the best price. They're wanting to get a fair price, and they're maybe willing to work with you a little bit. Desire to relocate to a different section of the country. Some people do that. I've done that in my past too. So that may be one reason. It could be all kinds of reasons. Maybe all the kids live in Dallas now, and they've got grandkids starting to come up, and they don't want to live in the San Antonio market, so they want to go up in Dallas. Excellent reason to get rid of a business. You don't want to run it long distance, so that's a good reason. Makes sense. Decision to accept a position for another company. My question is going to be to you, why? I mean, was it a deal so big they couldn't afford it? Couldn't afford to turn it down? Because if you got your own business, you've got more independence, you should have enough income, and probably as much or as you could with another one. So you got to really try to delve into that type of question. If it's unprofitable, well, if it's unprofitable, do you want it? Is there reasons it's unprofitable because he has 4 family members sucking the company dry and you won't be there? Understand, but delve into the reasons why and how you can change it immediately to get positive cash flow. Is it a loss of exclusive sales franchise? Remember I may have talked to you earlier if you've gone through the franchise model of operations, but franchises have the opportunity at any time, or franchisors, the ones who give you the franchise, they can say you're no longer a franchise anymore. If a good point in that again was Chrysler and GM when they cut back on so many of their dealerships. Many of these people just spent $2 and $3 and $4 million redesigning their dealers to the franchisor's requirement, and now they can't get cars and they're still stuck with that loan. So it may be something like that. If that's the case, you better evaluate the business based upon it not having that franchise. And if it is a franchise you're buying, make sure the franchise is going to be transferable before you buy it, or else you could be in trouble. And if you don't buy the corporation, or you have to put up another franchise fee for it, just keep that in mind. Maturing of the industry. There's a lot of industries that can be profitable in a maturing market. What do I mean by maturing? Well, let's say you're in an industry like I want to say widget manufacturing. I want to make it more practical. Let's say you're in a restaurant. That's a franchise that's done well in the past, but may not be doing as well now. Maybe at Chili's, and it could be a bad example. There's a lot of restaurants out there, a lot of franchises in that space. That doesn't mean that Chili's necessarily would be bad to buy. But it doesn't mean that there's going to be potential for great growth at that location. The maturing of the industry or the maturing of the area could be the fact that that industry was a real top-notch industry or business where it was at 20 years ago, but the population in the city has moved a different way, and it's not as strong in sales at that location. Again, it still might be profitable, but your chance for growth in that area may not be as much. Those are the questions you're really having to address there. And always remember beware of sellers who may have cooked the books. That's why you want a forensic type accountant who's done transactions before. Watch for what you're looking at, and that's another reason for buying the assets, because you can actually give the value. Understand having the location also is our goodwill is a value, so keep that in mind. And if you don't know what goodwill is, it's basically the premium above the asset cost that's on the books for that you're willing to pay for business for having that business that's already operational. It's a capitalized expense, which means it can be depreciated over time. And but it's an important thing because most businesses are going to sell as some kind of function of their income potential. Examining the financial data. Review financial statements. I say 3 to 5 years. Again, depending on the business. If it's something that moves quite a bit, then last 2 is important. If it's one that's maturing, you want to see where it used to be, and moving on 5 years is probably more important. Recognize the financial data could be misleading. I mean, are the assets overvalued? And when I value assets when I'm buying or selling a business, especially when I'm buying it, I value the assets. So what can I get for them right now? If I went and took them down to the pawn shop or went and took them somewhere, I don't care what he's depreciated them at. But oftentimes you'll find out that actually you've got a lot of assets that don't even show on the books, so they're zero already. Well, obviously they're worth more than that. So you're really looking at the assets at their true value. Expenses. Are they overstated, understated? Is the overhead too high for running this type of operation? Does it need to be pared back on those expenses? Got to look at that. Income. Is it underreported? Has he been basically taking some of the money out of the kitty to put it his wife and to try to keep from getting taxes? Well, maybe so. I found that in the financial area that probably 95 to 98% of all tax returns by business owners were somewhat, I'm going to put it, underreported. And so that could be the case, but you can't buy what's underreported. In other words, if he tells you you're making $150,000 a year in profit and he's really been making $250,000, but he hasn't been able to prove the other $100,000, that's his problem. He loses the value in the business because of it. Adjust asset valuations to reflect the true state of the business. Make them to what they're worth when you're buying them. Again, or buy it on a cash flow basis primarily, and we're going to talk about that now in evaluating it. There's more than this ways. There's derivatives of these, but these are some 3 base ways. Asset-based valuation. You're buying assets. Now, as a business, why do you want assets? Think about it. The only good asset does is to help you produce a revenue stream. If the assets aren't there, can you still produce the revenue stream? The only assets you might need is a customer list, but it doesn't reflect the valuation as much. But most people, when they sell business, they want to sell everything. They don't want you pick and choose. But you've got to evaluate those assets on what it can do for your business. The worst thing you can do is have a lot of money tied up in assets that are really not going to produce to the bottom line, because you may need new equipment or new services that you can put on the books to assist you in getting better revenue streams. And it may hinder you because you now have less cash to work with to buy the assets. The only thing good about assets oftentimes is that they're good help in terms of trying to get you money and borrowing it from potential lenders or private angel investors. Market comparable valuation. Now this is very good for real estate based type businesses, because what is the value of the real estate or the assets in the market? What are people paying for it? Now understand, people will pay for unreasonable amounts for some assets, i.e., if you look at franchises of the NBA, Major League Baseball, especially as professional sports franchises, if you look at the profit these people make and the evaluation they're given, you're talking about some cases you never get your money back. But those are called more vanity assets. But in most cases, you're talking about businesses that are similar to yours. So if you're buying a dry cleaners, you want to evaluate the businesses that have sold as dry cleaners in your city or in your area of comparable size, or adjust for those size variations and see what people are willing to pay for them. That's a fair market value. But again, most of the time it will take place, like if you're going to be selling several apartment complexes within your business, what are the apartments underlying the assets worth in their individual basis? So that's what market comparables are best for. My favorite method is some type of derivative of the cash flow based. Basically, you're wanting a return on the money that you're putting up. If you're buying a business for $100,000, and let's say it's cash, you want to have a reasonable period of time, because you got your effort in there. You want to be able to put your effort in it. As let's say a manager, you're going to get $35,000 a year. You say that's what I'd pay a manager. I'm taking that. You also want to get money back from your $100,000 investment in generally 3 to 5 years. Now, some people say, well, that's not realistic to say a certain amount of time. I've been looking at several different businesses, and there are a lot of good businesses in 3 to 5 years. That's 20 to 33% return of the money you put up. And of course, if you get to leverage it, in other words, if you can put up $10,000 and borrow $90,000, and you're still making $33,000, you can get over 100% return. So keep that in mind. But cash flow method is the best way, because you're going to have to be able to pay whoever you borrow the money from, or whatever equity position you have to sell off to help raise the capital. You're going to have to pay for it with the cash flow, free cash flow flowing after all expenses are paid. So keep that in mind. Non-quantitative factors in the factors. What's the competition? Is it getting bigger? Maybe they're quitting the business because 4 other companies, you may be a Ace Hardware in a medium-sized city, and now a Lowe's and a Home Depot's coming up. Well, you better know that before you buy it. The market. Maybe the market for their particular item is going out. I had a friend that I mentioned earlier in one of my first videos about how I sold some fans on a part-time basis in a micro-type business. Well, they had stores selling ceiling fans. You don't see stores selling ceiling fans anymore. Nearly all of them are by the big box stores, the Walmarts, the Targets, the Lowe's, the Home Depot. That market totally changed. So because of that, you better know your market and where it's going. Future community development. Is a community dying? Is it growing? Is it changing in racial and ethnic makeup? I know I'm not racist in this sound, but it may be a positive if that happens. Maybe the type of business you've got will be positively impacted by the changes in the community, and maybe negatively. So you've got to know those answers. Legal commitments. Do they have, they may be selling a business that the contracts or non-assignable. So when you get the business, now your vendors quit doing business with you. You've got no buyers and you've got no product. You're in trouble. So you better check those out. Are there union contracts? Maybe they quit because the union is about to come in there and they've got a big union contract is coming up. If that's the case, you better have it negotiated before you buy it, so you may have to reevaluate the business's worth. Buildings. Are there going to be buildings? If you can keep from buying a building, my preference to start on a new business is to not buy the building and do a lease back. The reason for it, quite frankly, you put too much assets into a business that generally will hurt your overall cash flow for the amount of capital you put into it. In other words, instead of that $100,000 for getting that $30,000 a year income, you may have to put $300,000 or $400,000 to get the building too, and you're still going to get $33,000 income. Not a very good return. And when I was mentioning earlier about 3 to 5 times, those were generally without buildings. With the buildings in there, you're generally looking nearly 10 times or more on the earnings because the building's separate. You really try, as a general rule, again, need to keep the building separate. And even if you do buy it, you do want to buy it as a separate corporation for a lot of liability reasons, which we can explain later. Product prices. Is your particular item getting cheaper or more expensive? Depends on what you've got. Those are things are important. Or maybe the product prices are coming up so fast the market won't sustain the increases. Keep those in mind. Negotiating the deal. What's the terms of purchase? It's not, most people, I will say this, most people, even on asset-based businesses, do not just write a check. Most of them give an amount of down payment, maybe 50%, and do 50% over time, but they may have to get a loan from an SBA loan or some type of loan to do it. But a lot of times, they'll have the individual person that will also carry the paper. You can also get factoring. There's different ways of doing it. We're not going to do that part of it in this particular video, but you've got to understand what the terms of the purchase are. Is there indemnification clauses? If this guy tells you something, whether he knew it or not, wrong, are they going to have to indemnify you for that? Are you payment in full or partial payment? Some people want cash only. Great. Cash only, if you can get the money, probably better because you can negotiate a better deal, quite frankly. Cash is king, so if you got it, you can tell them how you're going to do it. Closing sale, best handled by third party, a title company, an attorney. Now, bill of sale, tax certs. There's so much involved. This is just a couple of things. You really have to have a checklist and done by an attorney to make sure everything, because you got to make sure taxes have been paid up to date and that they're prorated generally to the time of closing. You need to know what the taxes are. You need to have everybody contacted as part of the closing procedure to tell them that it's been resold to somebody. Make sure all the contracts ahead of time are done, but nobody's going to let you do that until it's about ready to get closed. So keep that in mind. And payment to seller agreements and guarantees. You're probably going to have to guarantee a loan no matter who you make it to. Now, this doesn't tell everything about it, but I hope that you'll understand that it will help you get an idea about purchasing. We're going to have some more on purchasing a business in our resource section, and another video later on just purchasing and the procedures involved. Have a great day and good luck.